Today is Sunday, February 8th, 2026. Silver is currently trading at $77.9 per ounce. Gold sits at $4,966.26 USD per ounce. Spot price. Something strange is happening. Not on trading screens, not in headlines, but inside real bullion shops. Silver prices fall sharply. And instead of fear, buyers rush in, dealers aren't celebrating, they're tightening supply, raising premiums, and quietly asking one dangerous question. What happens if this inventory can't be replaced? Because when paper prices collapse, but physical demand explodes, history suggests the market is not calming down. It is breaking internally. And when that happens, the people watching charts are late, while the people watching behavior are already positioned. So the real question isn't whether silver is cheap. The real question is, who understands what this moment actually signals, and who doesn't? Welcome to Boring Currency Reports. If you've lived long enough to see booms, busts, and promises break, then you already know why calm analysis matters more than noise. If this channel respects your time and your experience, consider subscribing. Not for excitement, but so you don't miss signals others ignore. And before we begin, tell us something simple in the comments. Where are you watching from today? The story did not begin on a trading screen. It did not begin with a breaking news banner or a sudden spike on a chart. It began quietly inside a small bullion shop, where behavior told a very different story than price. Silver prices had fallen hard. On paper, the move looked simple, another pullback in a volatile market. Analysts debated charts, commentators argued about causes, and online discussions reduced the event to quick conclusions. But inside the physical market, the response did not match the narrative. Buyers did not disappear. They arrived. The bullion dealer noticed it immediately. Foot traffic increased. Phone calls came in faster than usual. Familiar customers returned sooner than expected, and new buyers appeared with cautious urgency. They were not celebrating lower prices. They were evaluating risk. This mattered because physical markets do not react like paper markets. Paper markets move instantly. Physical markets move deliberately. When demand for physical silver rises during falling prices, it is rarely a sign of comfort. It is a sign of tension. Buyers sense a disconnect between price and reality. Most observers missed this signal because they were focused on charts. Price appeared to be falling, so the assumption was weakness. But price only shows what has already happened. Behavior hints at what may be coming next. The dealer understood this difference. They did not rush to sell aggressively. Inventory was leaving faster than expected, but replacing it was uncertain. Suppliers were cautious. Quotes were slower. The dealer knew that selling today created exposure tomorrow. This was reflected in premiums. Despite falling prices, premiums stayed firm. To some buyers, this felt unfair. To the dealer, it was necessary. Premiums were not just profit, they were protection against replacement risk, volatility, and supply disruption. Experienced buyers recognized this immediately. They did not argue about fairness. They adjusted their behavior. They bought carefully. They focused on liquidity. They accepted that prices could move lower. Newer buyers reacted differently. They focused only on spot price. They expected discounts. When expectations were not met, frustration followed. This emotional response often led to rushed decisions or complete withdrawal. The shop revealed a clear divide. Some participants sought certainty. Others accepted uncertainty and planned around it. The difference was not knowledge, it was discipline. Markets do not punish incorrect forecasts as harshly as they punish fragile strategies. Those without a plan feel every price move. Those with a plan treat volatility as part of the environment. The crowded shop was not proof that the bottom was in. It was evidence that the market was under stress. Paper prices signaled weakness. Physical behavior signaled urgency. When these signals diverge, instability grows. This was the real warning, not about silver alone, but about how markets fracture under pressure. The signal was visible. Most people simply were not watching the right place. The premium paradox. The confusion began the moment buyers noticed something that did not make sense. Silver prices were falling, yet the cost to buy physical silver was not. In some cases, it was rising. For many observers, this felt like a contradiction. For professionals, it was a warning. The bullion dealer had heard the complaints all day. Buyers pointed at their phones, showing lower spot prices, expecting cheaper metal. The dealer responded calmly, repeating the same explanation with slight variations. Price and cost were not the same thing. And in this moment, cost mattered more. Premiums exist because physical markets carry risks that paper markets do not. Every ounce sold must eventually be replaced. When prices move slowly, replacement is predictable. When prices move violently, replacement becomes uncertain. Uncertainty forces protection. The protection shows up as higher premiums. The dealer was not reacting to today's price. They were pricing tomorrow's risk. This is where many business-minded individuals misunderstand the system. They assume premiums are discretionary, flexible, or opportunistic. In reality, premiums compress only when confidence exists across the supply chain. When confidence disappears, premiums become rigid. In this case, confidence was gone. Wholesalers were slow to confirm orders. Mints delayed shipments. Logistics costs fluctuated. At the same time, customer demand surged unexpectedly. This combination created pressure from both directions. Inventory flowed out faster than it could be replaced, while future supply became harder to price. The dealer faced a simple but uncomfortable question. If this ounce sells now, what will it cost to replace it later? Without a clear answer, the rational response was caution. This is the premium paradox. Falling prices do not automatically reduce real-world costs. Sometimes they increase them. When volatility rises, risk pricing overtakes price tracking. The market shifts from efficiency to survival. Experienced buyers recognize this immediately. They did not argue about fairness. They understood that premiums were signaling stress. Instead of demanding discounts, they adjusted behavior. Some reduced order size, some switched products. Some delayed action altogether. Each response reflected risk management, not emotion. In contrast, newer buyers fixated on the perceived injustice. They believed lower prices should guarantee lower costs. When that expectation was violated, frustration followed. This emotional response often led to poor decisions, either overbuying out of fear or exiting entirely out of distrust. From a strategic standpoint, this dynamic mirrors other industries. When supply chains tighten, prices become less relevant than access. During crises, businesses do not compete on margin alone. They compete on reliability. Those who survive are not those who buy cheapest, but those who manage exposure best. The bullion dealer operated under this same logic. Premiums were adjusted not to maximize profit, but to control flow. Slower sales meant longer inventory life. Higher premiums filtered impulsive buyers from deliberate ones. This was not manipulation. It was risk discipline. Another overlooked factor was time. Physical markets move slowly by design. Orders take days or weeks. Verification takes effort. Transport carries cost. When prices swing sharply, time becomes a liability. Selling too aggressively today can create a gap that cannot be filled tomorrow. This is why premiums often lag price declines but react quickly to demand spikes. They are not a reflection of optimism. They are a reflection of fear, specifically fear of being exposed on the wrong side of the next move. For business leaders and entrepreneurs, the lesson is uncomfortable but clear. Price signals are incomplete without context. When volatility increases, secondary costs dominate. Insurance, financing, replacement, and operational stress quietly reshape the equation. The premium paradox also exposes a deeper truth about market narratives. Many participants want a villain. They blame dealers, intermediaries, or unseen forces. But in most cases, the system is responding logically to stress. The behavior may feel unfair, but it is rarely irrational. The dealer did not celebrate high premiums. They worried about them. Elevated premiums reduce liquidity. They slow turnover. They signal dysfunction. But lowering them prematurely would be worse. It would mean transferring risk from the buyer to the dealer, an unsustainable trade. This is why premiums matter more than most people realize. They are not noise. They are data. They reveal where confidence is breaking and where friction is building. At this stage of the story, one thing became clear. The real danger was not whether silver prices would rise or fall next. The danger was misunderstanding what the market was already saying. Premiums were speaking. Most people simply did not know how to listen. And that misunderstanding would have consequences as volatility continued to unfold. Paper markets and the illusion of control. To understand what was truly happening, one had to separate two markets that looked connected but behaved very differently. One existed on screens, moving at the speed of algorithms. The other existed in vaults, shops, and delivery trucks constrained by time and logistics. Most participants treated them as one system. They were not. Paper markets are built for speed. Contracts change hands in milliseconds. Risk can be added or removed instantly. When fear enters the system, paper markets absorb it first. Selling accelerates, prices drop, and volatility explodes. This creates the illusion of control. Participants feel they can exit whenever they want. Physical markets do not offer this luxury. There is no instant exit. Metal must be sourced, verified, stored, and moved. Every transaction has friction. This friction is not a flaw. It is a stabilizer. But under stress, it becomes a bottleneck. As silver prices fell rapidly on paper, sellers rushed to reduce exposure. Funds rebalanced. Traders closed positions. None of this required metal to move. The price adjusted without physical confirmation. On screens, the market looked decisive. In reality, it was incomplete. Inside the bullion shop, this disconnect was obvious. The dealer was not responding to charts. They were responding to inventory levels and supplier behavior. Paper selling had pushed the price down, but it had not increased supply. In fact, it had done the opposite. Lower prices triggered more physical demand, not less. This is where the illusion of control becomes dangerous. Paper markets allow participants to believe that liquidity is endless. Physical markets prove that it is not. When many participants attempt to act at once, paper absorbs the shock. Physical cannot. Some buyers blamed paper markets for manipulation. Others accused them of distortion. These arguments missed the point. Paper markets are not designed to reflect physical reality in real time. They are designed to manage risk quickly. In moments of stress, they become shock absorbers. The dealer understood this role. When paper prices collapsed, it did not mean physical value had collapsed. It meant risk was being transferred. The question was not whether paper markets were right or wrong. The question was where that risk would land next. For business decision makers, this distinction matters. Paper markets are useful for hedging and price discovery, but they do not guarantee availability. Physical markets guarantee availability, but they do not offer flexibility. Confusing the two leads to false confidence. As paper selling intensified, wholesalers became cautious. They widened bid-ask spreads. They reduced firm quotes. They protected themselves against further downside. This behavior rarely appears on charts, but it defines real-world outcomes. The result was a feedback loop. Falling prices increased physical demand. Increased demand tightened supply. Tightened supply increased premiums. Higher premiums discouraged some buyers, but confirmed urgency for others. Meanwhile, paper prices continued to fluctuate independently. This divergence created stress across the system. Dealers hesitated to commit inventory. Buyers hesitated to wait. Wholesalers hesitated to promise delivery. Each layer added friction. None of this was visible in a candlestick pattern. Experienced participants recognized the pattern. They had seen it in previous cycles. Paper markets moved first. Physical markets responded later, often violently. Sometimes price rebounded. Sometimes it stagnated. But calm rarely returned quickly. The illusion was believing that paper prices alone told the story. In reality, they told only the first chapter. For entrepreneurs and investors, the lesson is structural. Systems optimized for speed behave differently under stress than systems constrained by reality. Speed amplifies reactions. Friction reveals limits. When the two diverge, instability follows. The bullion dealer did not attempt to predict the outcome. They focused on survival. Inventory discipline, cautious pricing, and controlled flow were their tools. In uncertain environments, control beats conviction. Meanwhile, buyers faced a choice: trust the screen and wait for confirmation, or trust behavior and accept uncertainty. Each choice carried risk, but only one acknowledged how the system truly worked. Paper markets offered clarity. Physical markets offered truth. And the growing gap between them signaled that the market was entering a phase where assumptions would be tested and mistakes would be costly. Human behavior under price stress. When prices move slowly, decisions appear rational. When prices move violently, behavior reveals itself. The bullion shop became a small laboratory for observing how humans respond to uncertainty, loss, and pressure. The metal was secondary. Psychology was primary. Some buyers entered with urgency. They spoke quickly. They referenced charts. They wanted reassurance. These were not casual visitors. They were reacting to price, not planning around it. For them, the drop felt personal, as if the market had challenged their beliefs. Others behaved differently. They asked fewer questions. They took more time. They focused on quantities and liquidity rather than predictions. These buyers were not calm because they knew the future. They were calm because they had accepted that they did not. The difference between these two groups was not intelligence, it was preparation. Price stress triggers predictable errors. One is panic buying. When prices fall sharply, some buyers increase order size, hoping to erase previous losses. This behavior feels decisive, but it is often defensive. It is an attempt to regain control, not to manage risk. Another error is paralysis. Faced with conflicting signals, some participants do nothing. They wait for clarity that never comes. By the time confidence returns, the opportunity, or the risk, has already shifted. The most dangerous error is revenge buying. This occurs when individuals respond to loss by taking larger positions without adjusting strategy. In business, this is equivalent to doubling down on a failing model without understanding why it failed. The bullion dealer observed all of these behaviors in real time. They did not judge them. They recognized them. Markets are emotional systems operating under the illusion of logic. When volatility increases, emotion moves faster than analysis. Experienced participants understood this. They were not immune to stress, but they had rules. They did not allocate capital based on headlines. They sized positions conservatively. They accepted that timing would never be perfect. This mindset is common among durable businesses. Successful operators do not attempt to optimize every decision. They focus on staying solvent. They build margin for error into their plans. In volatile markets, this discipline is rare but decisive. The shop conversations revealed another truth. Many participants monitored prices obsessively. They refreshed screens repeatedly as if attention could influence outcome. This behavior increases anxiety without improving decisions. It narrows focus and amplifies noise. Those who had been through previous cycles recognized this trap. They limited exposure to constant information. They treated volatility as an environment, not an emergency. Their actions were deliberate, not reactive. From a strategic perspective, this distinction matters more than price direction. Markets punish emotional leverage. They reward process. The human tendency to seek certainty is strongest when certainty is least available. In such moments, people look for narratives. They want simple explanations and clear villains. This reduces cognitive load but increases error. Inside the shop, these narratives surfaced quickly. Some blamed external forces, some blamed institutions, others blamed timing. Few examined position size, time horizon, or liquidity needs. Yet these factors determined survival far more than predictions. The dealer noticed another subtle behavior. Some buyers adjusted not what they bought, but how they bought. They chose more liquid products. They avoided niche items. They prioritized flexibility. This was not about belief, it was about optionality. Optionality is the ability to adapt without panic. In business, it means maintaining cash reserves. In markets, it means avoiding overcommitment. Under stress, optionality becomes priceless. Younger participants often underestimated this. They focused on maximum upside. Older participants focused on survivability. Experience had taught them that the market does not care about conviction. It cares about endurance. This generational divide was not ideological. It was experiential. Those who had witnessed previous dislocations knew that volatility rarely resolves cleanly. It drags, it exhausts, it tests patience. The most revealing moment came when a buyer admitted discomfort. They acknowledged that watching prices move had affected their sleep and decision-making. This honesty shifted the tone. Others recognized themselves in the statement. Markets are not abstract. They invade personal life when exposure exceeds tolerance. This is the hidden cost of poor sizing. The lesson of this phase was not about silver. It was about human limits. Systems fail when participants exceed them. Price stress does not create weakness, it exposes it. And as volatility continued, those without emotional and strategic buffers would face decisions that felt urgent, but were actually avoidable. The industrial reality behind the metal. While most conversations in the shop revolved around price and timing, a quieter truth sat beneath the noise. Silver was not only being discussed as an investment, it was being consumed. This distinction mattered more than most participants realized. Unlike purely monetary assets, silver has a dual identity. It functions as a store of value, but it is also a critical industrial input. It moves into factories, electronics, energy systems, and medical equipment. Once used, it does not return to the market quickly, if at all. This reality creates a structural floor that price alone does not reveal. When paper markets sell aggressively, they assume supply is elastic. They assume material can reappear when price demands it. Industrial demand challenges this assumption. Consumption continues even when investors hesitate. Manufacturers do not pause production because prices are volatile. They adapt, they hedge, they negotiate contracts, but they continue to consume material. This ongoing demand quietly competes with investment demand for the same supply. In the bullion shop, this fact was rarely mentioned, yet it shaped everything. Wholesalers were not only watching investors, they were watching industrial buyers. Long-term contracts, fixed delivery schedules, and strategic stockpiling reduced the amount of metal available to respond to sudden retail demand. This is why physical shortages can appear without warning. Supply does not vanish, it becomes committed. Business leaders understand this dynamic intuitively. When inputs are essential, companies secure them early. They do not wait for perfect pricing. They value continuity over optimization. Silver's role in electronics and energy infrastructure makes it difficult to substitute. Efficiency improvements reduce usage per unit, but total demand can still grow. This creates a paradox. Consumption becomes more efficient, yet more widespread. This matters for market behavior. When price declines sharply, industrial buyers may increase coverage. Lower prices improve margins. Long-term planners take advantage of volatility rather than fear it. Their actions do not appear on retail forums, but they affect availability. For investors focused solely on charts, this creates blind spots. Price may signal weakness, but underlying demand may remain firm. This disconnect delays adjustment and amplifies volatility. The dealer was aware of this pressure. They understood that some supply was effectively locked away. This knowledge influenced how they priced inventory. Replacement risk was not theoretical, it was operational. From a strategic standpoint, this highlights an important lesson. Markets are shaped by users, not observers. Those who consume a resource behave differently from those who trade it. Industrial demand does not speculate. It plans, it budgets, it commits. This behavior dampens price sensitivity but increases scarcity during disruptions. Entrepreneurs can relate to this dynamic. When a critical input becomes uncertain, businesses prioritize access over cost. They pay premiums to protect operations. This shifts bargaining power away from marginal buyers. In the case of silver, this meant that not all demand was visible. Retail flows were only part of the equation. The deeper pressure came from steady, less visible consumption. This is why simplistic narratives fail. Markets are not driven by a single force. They are layered systems where different participants operate on different timelines. Short-term traders react to momentum. Long-term consumers focus on continuity. Investors oscillate between the two, often misreading both. The danger arises when participants assume that price alone reflects all information. In reality, price often reflects the most liquid segment, not the most committed one. As volatility persisted, this industrial undercurrent acted like a slow current beneath rough waves. It did not dictate immediate direction, but it influenced how far price could fall without consequences. This did not mean a bottom was guaranteed. It meant that the system had constraints. Constraints matter in every business. They define what is possible, not what is probable. Understanding silver without acknowledging its industrial role is like analyzing a company without understanding its customers. The market could remain unstable. Prices could move lower. But the metal was not idle. It was being used. And that reality would shape the next phase of the story, whether participants recognized it or not. Is the bottom in, or is this a trap? By this stage, the most important question was no longer about price. It was about judgment. The bullion shop, the premiums, the behavior, and the industrial undercurrent all pointed to one uncomfortable truth. Certainty was unavailable, and that made this moment dangerous. Many participants wanted a clear answer. They asked whether this was the bottom. They wanted confirmation that risk had passed. This desire was understandable but misplaced. Market bottoms are not events. They are processes. They reveal themselves only after they are gone. The dealer never answered the question directly, not because they were evasive, but because the question itself was flawed. A bottom assumes symmetry. It assumes that once price falls far enough, stability returns. History does not support this assumption. What the dealer observed was not confidence, it was tension. Buyers were active but cautious. Sellers were present but selective. Inventory moved but not freely. This was not resolution, it was transition. In such environments, the greatest risk is overcommitment. Participants who act as if clarity has returned expose themselves to prolonged stress. Those who treat volatility as temporary often underestimate its duration. Experienced participants understood this. They were not trying to be correct. They were trying to be resilient. Their strategies were built to survive multiple outcomes, not to optimize a single one. This distinction separates speculation from strategy. Speculators require timing. Strategists require structure. The individuals who fared best in previous cycles were not those who bought the lowest price. They were those who sized positions appropriately, maintained liquidity, and avoided forcing decisions under pressure. The bullion shop reflected this wisdom quietly. Buyers who returned repeatedly did not increase size dramatically. They spread purchases over time. They accepted that prices could fall further. Their goal was participation, not precision. This approach frustrated those seeking validation. It felt passive. In reality, it was disciplined. The trap in moments like this is narrative certainty. When markets become volatile, confident voices grow louder. Predictions multiply. Each claim offers relief from ambiguity. But relief is not the same as safety. For business leaders and entrepreneurs, this lesson is familiar. During economic stress, decisive action is praised. But decisive action without accurate information can be destructive. Survival often depends on restraint. The market environment described here did not demand bold bets. It demanded risk awareness. The question was not whether silver would rise. The question was whether participants could endure further instability without being forced into poor decisions. The dealer's behavior offered a clue. They did not expand aggressively. They did not liquidate inventory. They maintained balance. This neutrality was not indecision. It was positioning. Positioning allows flexibility. It preserves options. In uncertain environments, optionality is a competitive advantage. The same principle applies beyond metals. Businesses facing volatile demand do not maximize leverage. They preserve cash. They renegotiate terms. They prepare for multiple scenarios. Those who fail are often those who assume recovery will arrive on schedule. Another overlooked risk was emotional fatigue. Volatility exhausts attention. Participants who monitor markets continuously lose perspective. Their decisions degrade over time. This is why prolonged instability is more damaging than sharp shocks. The shop conversations hinted at this fatigue. Buyers spoke of stress, of constant monitoring, of pressure to act. These signals mattered. Markets break people before they break systems. This is why the idea of a clean bottom is misleading. Markets rarely offer relief on schedule. They test conviction until it weakens. Only then does stability emerge. From a strategic viewpoint, the correct response was not prediction, but preparation. Clarifying time horizon, limiting exposure, choosing liquid instruments, accepting uncertainty. Those who asked better questions fared better. Instead of asking, "Is this the bottom?" they asked, "What happens if it isn't?" That question changes behavior. It forces planning. It reduces fragility. The final lesson of this episode was not about silver. It was about process. Markets reward those who respect complexity and punish those who demand simplicity. Whether prices rose next week or fell further was secondary. What mattered was whether participants had structured themselves to survive either outcome. The bullion dealer did not know the future. Neither did the buyers. But some were prepared for it, others were not. And in markets like these, preparation is often the only edge that matters.